Hello and welcome to Academic Market Insights. I'm Russell Rhoads from the Kelley School of Business, and I'm with Dr. Larissa Adamiec, who is also at the Kelley School of Business. This is our first episode, and we came up with this idea after both of us realized that periodically we would create videos about what was going on in the markets and use those videos in the classroom. So we decided there's more than enough things to talk about in the markets, and we both selected a topic this week that's pretty timely. I'm going to let Dr. A introduce herself a little bit, and then she's going to dive into the Longshoreman Strike. And then I'm going to talk about non-farm payrolls, which we're speaking to you on a payroll week, but it's not about this report. It's about what we look for in the reports, etc. So, Dr. A, I'm handing it off to you. Introduce yourself, and you can jump right into your presentation as well.
Sounds good. Thanks so much. We're really excited to be here and to be doing this. Again, we've been working with students for a long time. We were just discussing how Russell and I have known each other for over 15 years. When he was head of education at the Chicago Board's Options Exchange, and I worked in education at a firm called Peak Six in Chicago. And we would just run into each other in the same circles and different things. I would sometimes substitute teach for him over at SIBO. And then when I started my academic career, I was able to hire him as an adjunct over at Benedictine University. Also, when I was a doctoral student at Illinois Institute of Technology, Russell was gracious enough to allow me to do tours with the students, which they loved on the trading floor. It was one of the highlights of my particular class, and it was a unique class, and I apologize for going on this tangent because it was a study abroad class, and the students, this was the highlight of the entire program. So not only was it the highlight of the class, but it was the highlight for all the students of the entire study abroad program. So thank you so much for that. We're very excited to talk about today's topic, and it was by coincidence that our topics just really happened to meld well together. So we're going to be talking about the maritime strike. However, we're really going to be diving into the economic impact of that strike. So we'll look at it from a micro and a macroeconomic perspective. And then when Russell talks about the unemployment number, because that's a little bit future looking, because that's coming out on Friday, we're going to be able to discuss how some of these things intertwine and meld together. So very exciting. Okay, with that, let's get started. Let me share my screen here.
We did want to incorporate the awkwardness of teaching online
It
for formality's
is.
sake.
And the transitions and everything else. And this is really meant to be a very casual experience because, again, this is for just discussion. How would we introduce a specific topic into the classroom? I have been fortunate enough to been granted to be able to teach economic courses, and this is definitely something that I would discuss in the economics courses. Okay, so I think we're jumping into your slides. Again, nice awkwardness of teaching. So let's start with where I am. We're going to be looking at this from both a micro and a macro perspective. And this shouldn't really say price basement, but we consider this a price floor on labor. Okay, and so we're going to have not quite the equilibrium. We're going to artificially force a price floor on how much these people can be charged for the cost of labor. And if we can separate ourselves from that it's a wage and really think about it as the cost of labor, we can then go ahead and use our supply and demand curves, which we're going to do, and really think about what is the correct price, what is the correct amount of quantity. And then we'll talk just briefly about the macroeconomic issues that are going to come out of this. So I always like to start at the beginning. And if you've taken any economics class, this is usually putting together a circular flow. I don't necessarily like the circular flow chart because every time you look at it, I feel like you really have to study it and study it hard to understand what's happening in this chart. So I want to simplify this and say households are going to supply 4 different things to you. They supply labor, they supply capital, they supply natural resource and entrepreneurship. So let's define what each one of these are, and then we'll talk about how the households are compensated for it. So labor is not only physical labor, but intellectual labor. So for example, Russell and I are both professors. We do not move anything. We do not create anything. We are not physically doing a whole lot except for, waving our hands around and maybe smiling, right? But there's not a lot of physical things that we're being paid for. We are not building things. We could make the argument we're building decks or our PowerPoint presentations, but that's not the same as actually building a widget. However, we are still providing intellectual capacity, and we're being compensated for that with a wage. So we receive wages for that labor that we provide. We can also provide capital. So capital is going to come from the idea if we have any savings. Savings are any amount of money that we have that are excess over our consumption. So we're very, very focused on how much can we consume, what kind of new car can we buy? What kind of new, well, I have a 3 and a 7-year-old, which speaking of which, I need to say good morning to, I almost forgot. Good morning, Luke. Good morning, Nicholas. You're both at school. I hope you're having a wonderful day. So things that I spend a lot of my excess income on is toys. Somebody once said to me, you are going to buy so many toys. And I thought, no, I'm going to be a mom that's very strict about these toys. Not the case. I have piles and piles and mountains of toys. Luke was once punished and he said to my father, can you get me those toys? And it was a big box. And he says, no. And then Luke said, well, what about that box of toys? And my father said, how many boxes of toys do you have? And Luke then went around the house and showed him and he thought, okay, so any excess capital that we have that we're not consuming, we can then provide to businesses, and what we'll earn in return is interest. So again, we've just established that we're providing labor. We can also provide capital. Our natural resources are land that we own. So for example, if you own a home and then you decide to rent it out, that is a natural resource. And what you're going to be compensated for is rent. Now, the 4th item is a little trickier because it is not technically labor. It is entrepreneurship. So think about the people who start these new firms. These people are going to be receive profits, and profits are very different than straight wages. Okay, so again, households provide labor, capital, natural resources, entrepreneurship, and in return, we receive wages, interest, rent, and profit. Now, the prices and the demand and the quantity are going to be defined by our supply and demand curve. Okay, so we have, and can you see my arrow? It's an arrow.
Yeah, we can see
Okay,
your, yeah.
so we have price, oops, and quantity. The amount that is supplied by our households is going to be our supply curve. The amount that is demanded from our firms is going to be from our demand curve. So as the price of something goes up, we're more willing to supply it. So for example, if I'm paid $20 an hour and all of a sudden the price goes up to $50 an hour, I'm much more willing to work a couple extra hours, okay? And so it's going to be an upward curve, sloping curve. Conversely, if we have a demand curve, the cheaper it is, the more we're going to want it. So for example, if the price of, I don't know, a toys drop from $100 to $10, I'm more willing to buy more of those goods. Okay, so this is how these two intersect. And where they intersect, this little star, that's our point of equilibrium. This is what properly defines how much we should be selling at and how many we should be making. And just a little caveat, financial products work the same way. There is demand for those products and there is supply for those products. And where those two intersect becomes the market price. And I apologize for that. And when we have a new supply or we have a change, we're going to have a change in our price and our change in our quantity. So if we have a reduced amount of supply, our price is going to go up and our quantity is going to go down. So we're going to have a new price for our labor. Okay. So that is going to completely change where our optimal or our point of equilibrium for our price and our quantity are. So if we look back, we see that our star is much lower. Now we see that our star is much higher. What is happening, and this is a long-winded way of getting to our debate or discussion, is the union for these workers are looking to change their union price. And so they are creating an artificial change. So the supply and the demand aren't changing, but they want to have a higher price. So they are forcing, and this is going to create some excess waste. So they're going to force the price of labor to go up. And I think Russell was telling me this morning that they were offered a 50% raise, which I think is astronomical and huge. And if they can pull it off, good for them, even though it'll be a negative for all of us. But it will also, they're asking for a 77% gain. So they are artificially changing their supply and demand graph. Okay. So this is not how things naturally happen, and they're forcing that price floor. Okay. And so what will eventually happen, or I take that back, we're moving to a macroeconomic topic, but sticking with the microeconomics, eventually the price and the supply and demand will shift so that we hit an equilibrium again. Okay. And normally here I'm so accustomed to saying, are there any questions? But there's nobody here to ask questions for. Okay, so now let's talk a little bit about the supply chain. One of the things we want to say about the supply chain is if all of these shipments are going to be slowing down, it's going to slow down the entire supply chain, which means our supply is going to shift inward, creating a higher cost. Okay, so let's take a look at this. So we're going to have less supply of our goods, and we're going to have, that's going to force a higher price, and that's what we're going to have to pay. So think back to COVID when we had that panic for toilet paper, right? The cost of toilet paper all of a sudden went sky high. My sister sent me pictures of our stockpile, and I thought, oh my goodness. So we could easily be in a situation just like that
Here
with our
comes a
supply
chime
chain.
in. Dun dun
Yes,
dun. I saw on the news, and we're recording this like the day after the strike started. I saw on the news your favorite place, Costco, had enormous lines where people are making sure that there's already some hoarding going on based on the news.
right.
So the impact's already happening.
And Costco, so if you are one of my students, you know that Costco is by far my favorite store. I even have the Costco pajamas. They're lovely. My kids love to look at me in them and you point out little things on it. Costco does very well in times like this. Okay, so this is really good for a company like Costco because people panic and they panic buy. And Costco, I don't know if you've ever shopped at Costco, but Costco's one of those places where I feel like if I can get out for less than $500, it's a win for me because not only do I go in there to buy toilet paper, I'm like, oh, batteries. I need batteries. Oh, face cleaner. I need face cleaner. And
I need
now
a pinball machine.
I they have it right now.
I know.
Yep, it's their Christmas selection. Luke is all about it. He hops out of the cart and he says, "Okay, I'm going to play." And he's desperate for the Pac-Man. They have a standalone Pac-Man arcade. So yeah, they're out right now because the Christmas stuff is out. My concern, and I'd be curious what you think about this, Russell, is this is very reminiscent of what happened in the early 80s when the air traffic controllers went on strike. And there comes a point where the government could easily step in and say, we can't have this because it's could be so detrimental to the overall country's economy. What do you think?
Yeah, Reagan fired him. I think it was back in '81, early on in his tenure as president. And if you think about it, the economic situation was kind of the same as we're in now. We were coming off of inflation in the '70s, lots of concern about growth, et cetera. And then you have a bunch of basically government employees that went on strike. Reagan said it was illegal for them to strike and I believe, managed to replace all of them. I I feel like the getting stuff in and out of the country is more essential than us being able to fly from one place to another. But on the other side of it, I'm not sure if uh, the current president has the authority to fire all of them. I mean, I think the companies have the employers have the ability to fire all of them. But my understanding is the one power the president has is they can declare a 90-day cooling off period where
Okay.
they all have to go back to work. And I saw one of the union guys being interviewed about that, and he said, "Well, if I move 30 boxes an hour normally, they make me go back to work. I can probably move 7 or 8 an hour." Yeah, so you get the nice work slowdown as well. I'm really not sure. I feel like if you're doing any sort of trading whatsoever around the implications of the strike and they order them back to work for 90 days, that that might be if you're short something that you think is going to get hurt by the supply chain issues, that might be your opportunity to put a short on when the market has a knee-jerk reaction to some sort of announcement like that. But we'll see
Or
how the thing plays out.
or if you're long Costco, people
Yeah,
are,
just buy
yep,
Costco. Yeah,
Costco.
it's defensive. It's a growth stock. It's an end of the world stock.
And they have strong cash flows.
Yeah. And they're financially strong.
They're financially strong.
Yeah.
Also, one of the stuff that I've been hearing about, specifically the strike, is that given the tight presidential race, that this will
Yeah.
be an additional challenge for both candidates.
And we try really hard to avoid politics, but you
Mhm.
generally would associate you generally associate unions with the Democrats, not with the
Right.
Republicans, which makes it kind of unusual unless and this is a big old conspiracy theory that I do not believe, but I did hear this thrown out that an October surprise might be Kamala solving the strike.
And if she can do it successfully, this could
I don't
bode
I
really
don't
well.
but I'm probably naive and I'm not a lifelong politician. But and I like to believe that people aren't that nefarious, but I heard that one thrown out. I don't believe that one, but it's kind of an interesting theory because
And
why
it's
else would they do this to, for lack of a better way to put it, their people?
well, and again, their demands, it's not a small raise that they're asking for.
No,
They're going,
it's like, it comes to like 10 or 11% a year when with what they're asking for. I
which
think
is
it's 6 years, 77%, but still,
that's a lot of money.
6 years, 50% is, six,
Huge.
7% a year. I can't do the math that quickly, but it's still a pretty nice number.
It is.
Anybody that's in a job that's tied to inflation would be thrilled that their
Right.
raises would be thrilled to get a 7 or 8%, or definitely get an 11% raise a year.
Right. I think, oh, no, there one more slide. This is my last slide. I apologize.
Your cool
Again,
pictures.
get my cool pictures. So we're going to be looking at, again, just very briefly from a macroeconomic standpoint, we're going to have a huge impact on different firms. This is going to impact their income statements because we're going to have decreased revenue as they're not going to be able to sell as much. Most firms are not positioned like Costco, so we can make fun of Costco, but most firms really don't have the logistics system. And even Costco, if you walk into one of their warehouses, the amount of inventory that they have, and this is intentional. So if you ever walk into Costco, it's very vertical, meaning that if you want to buy toilet paper, you look up and you see all of these stacks of toilet paper. And that's to give you that encouragement that you can buy two or three or four or how many ever that Costco gives you the limit on. And it's the idea that you're not interfering with somebody else's purchase versus if you walk into a much smaller store and you see that there's only three things of toilet paper, you might only buy one as opposed to three. So we're going to see a decreased revenue. We're also, because of the increased payment, we're going to see an increased cost. So we're decreasing our revenue, increasing our cost, and our profit margin is going to be shrunk. So what this can eventually lead to is we're going to have some strategic decisions which are going to have to be made. And one of the things we were talking about earlier was, what do you do with this workforce? Do we automate this workforce? Do we want to keep continuing with these employees? Do we cut the workforce and expect higher a higher productivity? So we start to include, okay, we're just talking about moving 30 boxes to moving 7 boxes. Well, what if we put a work quota? If you don't move 30 boxes in the hour, you're not going to get paid the full amount. There's lots of different things that can be done that are going to be just strategic decisions that are going to come about because of this strike. And I think that's it. Yep, now it's you.
And we will switch over and I'll take over here. See how smoothly we can do this. Got to get, I was set up for yours and you were set up for mine.
That's funny.
So the non-farm payroll number, it's an annual, it's a monthly number that comes out, typically sparks discussion within the classroom. And there really are three um, there are three reports that we really care about each month. Typically, the GDP, which is very important, non-farm payrolls, and I would say right now any inflation-oriented reports, and then whenever the FOMC does anything. All of those are at the forefront right now. Regardless of what kind of environment we're in, the non-farm payroll report is one that the market is very focused on. It gives us a first look at the previous month's economic activity. So I'm sitting here on October 2nd, and typically this number comes out on the first Friday of a month. It'll come out Friday, October 4th, and it's going to be coverage of basically labor activity in September. So it's a first look at what was going on in September. And that's one of the reasons that we really pay close attention to the non-farm payroll report. We're often more volatile on employment day, and to the point of where you'll on average you will see S&P 500 one-day options price in a little bit less than a 1% move on a typical trading day. That jumps up to about 1.2% on employment day. So just markets always brace for excess volatility on the non-farm payroll report. It comes out at 8:30 Eastern on the first Friday of each month. And it's more than you're gonna hear. The first thing that you're gonna hear is what is the unemployment rate? Also, how many jobs were created? Sometimes that number does contract. We'll see that on a chart in a minute. And sometimes we care and sometimes we don't. Right now, because inflation is something that the market is still somewhat concerned about. That average hourly earnings component of the non-farm payroll report is going to get a really big focus. And by the way, there is a precursor to the non-farm payroll report. The folks over at ADP use the data that they have from basically doing payroll for a lot of private employers in the U.S. And they will tell you what average earnings, how they have changed. Uh, they just reported a 4.7% increase in
Mm.
on a year-over-year basis in salaries, which is not exactly. It doesn't sound like inflation's under control there. We often take the ADP number that comes out early with a grain of salt, because there can be a disconnect with the official non-farm payroll report that comes out. But on the Wednesday before the non-farm payroll report, we actually get the ADP report, which used to do a good job of predicting non-farm payrolls. There's more and more of a disconnect. I think part of that's because ADP is only looking at private employers. Non-farm payrolls will take other sectors into account as well. Now,
Quick
the
question for, wait, wait,
calculation. Oh, sorry.
quick question for our international students. What does ADP do?
ADP is one of the largest payroll processors in the United States. If you start, odds are, if you've worked if you've worked more than two jobs in the US, at some point your payroll was probably processed by ADP. You and I worked somewhere that was the case. So I'll just yeah, separately, but we both worked at a place where ADP
Oh, yeah.
was the payroll provider. So they have all of this data in place, and they've got I think probably more accurate data than the government's, because the government's is actually a survey. They call around and do a survey, and they call it the household survey because they speak to over 100,000 households, and they will ask, do you have somebody that's working age that's employed? And if they're employed, that's how we count who is actually employed. If you don't have a job and you're looking for a job, you are considered unemployed. Now, that number, the employed and the unemployed numbers together will give us an idea as to the overall size of the workforce. And this is an important number when you're thinking about the unemployment number. If it's very possible, unemployment, the number of unemployed folks, people that are looking for jobs right now, divided by the sum of the employed and unemployed, if people drop out of the workforce, if they're not looking for a job anymore, if they've just given up, or they've retired, then the denominator portion of the unemployment rate goes down, and unemployment could actually go up even if nobody lost their job, if just
Mm.
the denominator part goes down. So you do want to pay close attention to the workforce participation number, which is the total workforce number, because that number can go down, and you're going to see in a chart in a minute. I go back and look at the last 60 months, which includes COVID. You see a lot of people dropped out of the workforce, and we really haven't gotten back to the same size workforce since COVID.
Well, and if we
So the
talk
change in
about,
payrolls, and this number is in thousands, you can see, and I believe that was April of 2020 or March of 2020, we lost 2 million jobs.
mm,
Or we lost, excuse me. Um, so we lost, I believe, 20 million jobs. And then it took us almost a year to regain those. We lost 21 million jobs during
wow.
COVID. I just found my notes. And it took us, it was not until the middle of 2021 that all those jobs had been, the change in payrolls, the positive numbers overwhelmed the negative numbers. I mean, it's hard to see on here, but the change in payrolls has been pretty flat for 2024. The unemployment rate has been grinding higher. You can see that the unemployment rate spiked up to, I think it's 14.8% there, on in response to COVID, and then has worked its way back down. You can see that number has been grinding its way higher over really over about a year. It's subtle because of the scaling of the chart,
Right.
but over the course of a year, it really has been working its way higher, and a higher unemployment rate is going to be associated with some economic slowing. The cutting that we're getting in the rate cut that we're getting is due to concerns about economic slowing. So if the unemployment rate continues to grind higher, there may be a belief that the Fed's going to have to get more aggressive with cutting. And if that happens, if all of a sudden we see a shift in the projections for what the Fed's going to do at their next meeting to right now, I believe it's a 50 basis point cut. If they change it to 75 basis points, it's very possible that the stock market likes that. The stock market likes lower rates. So you could have a situation where the September number comes out and the unemployment rate has gone up, but if there's a belief that that's going to spur more aggressive Fed action, it could actually be considered positive for stocks. And I know that negative economic news being positive for stocks it makes you scratch your brain a little bit. But honestly, that's why we're talking about these things right now to explain why that happens. The labor force participation. This is the percent of working age adults that are in the labor market. You can see it was before COVID up between 63 and 64%. We have not returned to above 63% since COVID. And there were a lot of early retirements. I personally know. I'm in my mid to late 50s now. So I do know some people that maybe wanted to scale back how much they were working, or I know some professors that have gone to from full time to just adjuncting to keep themselves busy. I love one of them said, "My kids are grown. I'm not working full time for intergenerational wealth anymore. I want my time to be my own." And I think a lot of people took that started to think about time when COVID kicked in relative to money with respect to a source of happiness, etc. The month over month hourly earnings change. This is the inflation number. This is a number that we're going to be paying close attention to on a month over month basis, usually less than 1%. You can see that that number in 2020 spiked up tremendously. Had to pay a little bit extra to get people to come into work. Also, you had a lot of people that were in, and I don't want to get into the politics of this one, but you did have a lot of people that were paid to not go to work.
Hmm.
So maybe finding labor or people that were willing to come into work during the COVID situation uh, who didn't need to, that were not worrying about money. That did result in a little bit of a spike in the month over month hourly earnings. The annual one is a better number, and you can see that this peaked out in like the first quarter of 2022 and has been grinding lower. But look at that little blip on the far right where it ticked up a bit, and the year-over-year hourly earnings change was less than 4% for the last number that we got. As I just mentioned, that ADP number was 4.7%. So we'll see if that excessive ADP number gets followed through with respect to the non-farm payroll report as well. But you get both growth and earnings information from the payroll report, and this is really where the potential inflation may be coming from. Uh, it will. We have seen discrepancies in the employment report when we have situations like the longshoreman strike. So it will be interesting to see what kind, if the strike continues onward. Hopefully it won't. Hopefully they'll come to a decent resolution and everything will go back to normal. But if it doesn't, and watching the head of the union on TV talk about this, it sounds like they're in this for the long haul. You might actually see, you might see the unemployment rate go up. But you might see people that are claiming they're not in the workforce right now because they're on strike. So there's going to be some unusual things to try and pick through when we get the non-farm payroll report for October, which
Mhm.
would be reported on the first Friday in November, which is right after the election. So we are also getting the final non-farm payroll report before, and when I say this, this is tongue in cheek, the most consequential election of your lifetime. They say that about every election. So, real quick on the summary, I know Dr. A wants to ask me a question. I mentioned an unusual stock market response to an employment number that looks like it's bad for the economy. It really depends on where we are in the economic cycle. You'll hear pundits refer to good news being good news, and then sometimes good news being bad news. If we got a really strong employment number and we got a really strong um, hourly earnings number, that might be considered inflationary. If we end up in a second bout of inflation, the Fed's not going to be able to cut rates and the stock market's going to hate that. So too strong of a number could be taken negatively as well. We'll see how the number plays out. The market is currently expecting more rate cuts this year. There's a few tools, one on Bloomberg and one at CME Group, that you can get an indication as to what people are expecting as far as rate cuts go. And changes in that expectation often coincide with big moves in the stock market. So I like to pay close attention to that. So anything deviating from moderately slow growth and not too bad inflation would definitely be taken as a positive. So again, we will see on this employment number, but a lot of what I just said relates to future employment numbers, and a lot of what I just said, a lot of what Dr. A just said, will relate to other large strikes that have big ripple impacts, like the Longshoremen. I want my gummy bears from Germany. Don't stay on strike for too long.
And I like my cheap toys from China. So, you know,
There you go.
yeah.
So you can always, if they have stuff they haven't played with, you can always re-gift them. Just
Yeah.
saying.
There is we have now a very strong rule that if you haven't played with the toy for over a week, it's fair game to anybody in the house. You can't claim it as your own anymore because we have so many toys.
It's oh well. I luckily I have 18 and 20-year-olds. I don't have kids anymore. And I just let them work these things out on their own.
Yeah.
So any questions for me on the employment stuff?
No, you were able to answer all of my questions. I am looking forward to maybe next time we can discuss what happens if there's too many cut rates and how we can get a squeeze there. But I feel like that's a full nother topic
It is. When we
and a
get
very
close to
important topic.
the next FOMC, I I assume, like you, I've made a list of what I want to talk about here. And when we get close to the FOMC, I want to show how you do that on Bloomberg, and I also want to show how you can use the free tool at CME Group to get a handle on those numbers. Because I've been told by former students, teaching them that and how to look that up, it really has helped them in the workplace.
Good, 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 good. Yeah.
All right. Well, thanks for jumping on with me. Hopefully, we can gain some traction. And if anybody has any topics you think we should cover, that's what the
Mhm.
comment section is for. If you got other suggestions, constructive suggestions, I've gotten non-constructive suggestions. I'm used to them, but is what it is. But constructive suggestions, please send them on. And with that, we greatly appreciate you guys joining us. Anything you want to say, Dr. A?
No, this has just been great. I've thoroughly enjoyed it. Thanks for having us. Thank you for hosting, Russell. I hope that this is really good for the students.
All right, let's just hope that I wasn't muted the whole time or something like that.
Well, I could hear you, so that's a positive first step.